Hi, guys. Great to meet you. I'm Behrin, founder of Neutrl. I'm going to be speaking about something I've actually never seen myself discussed around synthetic dollars or stablecoins previously, even being a big DeFi yield farmer, is actually bringing on the highest form of delta neutral yield on-chain through OTC arbitrage. So as most of us we're actual traders or curators or actual big deployers into LP capital, know that most yield on chain right now is highly cyclical. It's actually capacity constrained. So the more you throw into it, it actually shrinks over time. And I think worst of all, it's non-sticky in the sense that once the yield is dried up, people move on to the next protocol or the next type of yield source. The other aspect is a lot of protocols now that are into synthetic dollars or some sort of stablecoin meta are actually providing just wrappers on Aave, like we generate 5%, etc. Something really different. So our solution is basically looking at the price dislocation that actually occurs on normal spot trading markets, across centralized exchanges, and the actual crypto OTC market or private markets. The difference here is this is not a new trade. This is a trade that's done by the best institutions in the space, the best market makers, the best actual funds. The only thing is that there's been no access for DeFi users and no access for other bigger public. The guys who have it are the guys who we all know their names, and they're either big OG DeFi angels like Julian over there, but no one else gets access to it. So what we thought of it is, how do we actually create the solution and tokenize it on chain? How Neutrl works. So largely, Neutrl, the protocol, goes to foundations, goes to treasuries, goes to big VCs that were early investors, goes to large angel investors after time, buys locked tokens OTC at discounts. What this means is we can go and buy Solana, AVAX, SUI at like 50 to 70% discounts in the private markets. And then at the same time, the protocol systematically opens shorts on Perpetuals across Binance, Bybit, OKX, Coinbase International, and any other exchange that has enough liquidity on it. A user will come to the protocol, deposit stablecoin, whether it's USDT, C, USDE, Athena stablecoin, and in the back end, they get a version of the synthetic dollar, and then the synthetic dollar over time will pay them the yield that comes out of these deals. And remember, this is real trading yield. This is yield that is not based on governance token emissions like we do see in other protocols. It's actual cash stablecoin yield that will get paid back. The hedging strategies are quite interesting. I think the only reason why this is actually possible, and it's been done over the last few years by institutional funds, is because of perpetual swaps. The current actual market and like open interest and volume of perpetual swaps across multi-sexes, and I'll take into account Hyperliquid as well. We built a tracker on that where you can actually see it. Happy to share it at another stage. Basically is 4 to 5x time normal spot volume of any of these sexes. So I think the three best instruments or things that have come out of crypto recently for a trader has been trading venues across multiple exchanges, stablecoins, synthetic dollars, and perpetual swaps in general. The market opportunity here is various ways you can cut it, so that's up to you to decide. But largely, I see stable coins or synthetic dollars specifically, like these yield tokenized products, grew from zero to just under $6.5 billion last year, largely driven by Athena and the team there, which are fantastic. What we've seen is that this is continuing to grow now with a lot of more competitors coming to the play. Some of them have actually spoken over the last 2 days, but a lot of them actually focus on liquid basis, delta neutral, which private funds do operate, which they've tokenized. We want to bring something different that hasn't actually been done. And the next few slides, I think I'll share a bit of alpha that you probably may not have seen. So largely, what drives supply into OTC markets? Why do foundations come to you? And how big can this really go? In the next 24 months, there's $55 billion worth of the top 100 market cap liquid tokens that will be unlocked. When this usually happens, foundations, early investors, or whales come to brokers, go to VCs, go to other angels, and they interact discounted tokens. Why do they sell it discounted? Because realistically, if you're a big early investor in one of the top protocols over the last few years, there's no liquidity on the open market. You're going to see a massive tank in the token price. And I think it's structurally due to the next slide. So largely, FTVs of most L1s, L2s are very, very high. It's largely been due to like VC capital investing over the last few years. This is an interesting slide in the sense that the actual dark line there is not the market price that was actually in May 2024. That was the OTC price that was done. So take into account that was already done at any discount between 20 and 70% of these large tokens A to J. And most names you would know pretty publicly. What's interesting is now, fast forward this year, from the OTC price, which is already done at a discount, the FTV now is much lower. So if you entered into this delta neutral strategy, you would have really made a pretty good return last year. And this is a slide that actually was real returns last year. So if it was done through Neutrl, these were deals that were done. And what you see is that privately from the team pre-Neutrl, what you see is actually the delta neutral, the darker line, is if you did normal, like an Ethereum, or like an Athena liquid basis or Resolve liquid basis, etc. You're buying spot, you're shorting perp, open market. And you'd get a decent return. You'd get something anywhere between, in a very bullish market, 10 to 25% on doing it on different names. If you threw in the OTC kicker, what you end up is an actual massive margin on top of it. And this is because the actual return is based on the OTC discount unwinding, as well as the basis, as well as like the staking yield that you can get from the underlying collateral as well. The big difference here, and I think why most people would not be able to do this, is really because of one of our co-investors. So this is Stix. They actually doing 85% of the OTC volume now. They work with most of the biggest market makers, biggest exchanges, as well as like other teams and foundations. So the Neutrl team speaks to foundations, we go to brokers, and we use people like Stix to actually get access to the best deals. And we're very fortunate to have them on as a co-investor. The interesting thing with OTC Arb is, as I mentioned, most profit changes are different type of strategies. Here, in periods of negative funding rates, we still make money. We actually make really good yield because the discount is still the discount that we got on the deal is actually eaten up. It still makes enough for negative funding rates. If it actually goes positive funding rates in general, like a normal liquid basis, it's just a bigger kicker to the actual return. Where are we right now? So we basically are not public yet. We started 2.5 months ago with this Neutrl idea. We're currently running $40 million into these type of strategies. We're working on releasing the public. We actually released the website yesterday and the public documentation, so happy to share that. And we're working on going fully public with DeFi composability with Morpho, Curve, Pendle, Athena, Ethereal in the next 2 months. Thank you very much. And I'd like to thank Stake Capital and the team for actually having us here. This is the first time we introduced Neutrl anywhere, so really appreciate it.